Hello guys, welcome to week 1 lesson 2 part 3 or module 1 lesson 2 part 3. Now in this part, which is the last part of lesson 2, we are going to be considering 3 basic sub-themes, right? And also note that we had discussed the part 1 of this lesson and the part 2 of this lesson in the previous video. So the first sub-theme we're going to be considering in this part is the types of Forex order. Types of Forex orders. Okay, so now you must understand that just like you go into a regular store, I started the course by giving an analogy that Forex is quite similar, a lot similar to what you do in everyday buying and selling in regular stores, right? And just as you go into regular stores to place order, you have some orders which are very instant and immediate. And then you also have orders that, you place them and they do not come immediately. They come predicated on a condition, right? So they are based on the fulfilling of a condition. Maybe you have to pay or they have to deliver it to you before you pay and all of that. So in Forex, there are basically 2 types of order, right? So the first one we have is we have market orders. So when you press the buy and sell button, there's market order, and then you also have pending orders. Okay. If we're defining market order, what you have to note is that, let me just define it shortly. An order instantly executed against the price that the broker has provided. So it's basically instant execution So let's go to the chart and show you an example. So in a situation where, and then I didn't trade on Friday, I traded on Thursday, and fortunately for me, it was a winning trade. Let's say fortunately, or yeah, it's one of those things where if you have a system that works over a long period of time, then your winners obviously would be higher than your losers in terms of how much you make when you win. I don't take the full TP. I exit my trade at this 0.5 level of the Fibonacci. So I waited for a sweep, waited for a shift in market structure, tapped in my 0.705 level of the Fibonacci, and then hit my take profit here. If you watch all these other take profit levels or the levels of the Fibonacci is yellow, I do not take them. So this is the trade. And I didn't go all the way. Disclaimer, this is where I left the trade. About 30 pips, 4.11 risk to reward ratio. So now let's go on to what I wanted to show you. So if you were to enter into the Forex market and let's say you have a system of trading a bullish engulfing candle, right? And in the bullish engulfing candle, you see a bullish engulfing candle here. This is a bullish engulfing candle because the white candle's body, is this a bullish engulfing candle? Yeah, it is. Let me look for a clearer one so it doesn't look as though I am teaching the wrong thing. I'm being quite careful with these videos. What's the problem with my network? I'm being quite careful with these videos though because, okay, yeah, beautiful. So let's say this is a bullish engulfing candle, right? So let's say you're entering a trade based off of this and your stop loss is here. You just wait for this candle to close and let's say you plot your long position. Long positions are for buy. Like I said in the previous video, your stop loss is here. Now, if you go to your MetaTrader application and then once this candle closes, you immediately enter a buy order. You just click on buy and then you come back to set the stop loss, okay, on your MetaTrader. I'll post it on the group, obviously. I'll post a short video of instant execution on the group. So you come back to set your stop loss and then you set maybe your take profit is 1:3. You drag this till this point here shows you 3. This point, right? It's on 2.99, almost 3. So let's just leave it this way. So you come back and then you put in this figure in your stop loss and you put in this figure in your take profit, but you just execute a buy trade without anything, just buy based off of this candle. Let's say you are trading your trading system is bullish, is a bullish engulfing candlestick. So a bullish engulfing candlestick is basically a candlestick structure where the buy candle or the bullish candle completely engulfs the body of the bearish candle, of the most recent bearish candle just before it. So in my charts here, you would discover that my bullish candles are represented as white and my bearish candles are represented as yellow. And the reason is basically simple. It's psychology. You see red, right? You see red oftentimes as the average person, red spells danger for you. So let me show you an example. So let's say you have this, you see, already it's changing and it spells danger for you. You see the red candles, right? Mine is yellow because yellow is a cool color. It doesn't give you much of an emotion, even though price is going against you, right? So you enter this here, back to what I was explaining. You enter your trade here, you just go to your MetaTrader and you click on buy, or your trade locker, or whatever it is that you use to trade. You just click on buy. That is an instant execution. That is an instant execution. But let's say you do not trade like this. You don't enter buy and sell trades immediately. Let's say you want to buy, I wouldn't explain a fair value gap now because I believe that people who are watching this video at this point are beginners. But let's say you want to buy somewhere here. For some reason, you feel price is going to come and take this low, and then you buy from this low because you feel liquidity is resting below this low, based off of your trading system. When I say feel, when I use words like feel, I don't mean your feelings. I mean based off of your trading system. You feel like price is going to come and then maybe get this low here, and for now price is somewhere here. Let's say this has not happened. Let's just completely, say all of this point hasn't happened. Or should I just use a recent market price action? Okay, let me just use a much more recent price action. So based off of the trading on Friday, you feel like price is going to come to this low, right? This swing low here. And then you draw a line, right? Based off of your system, you think maybe if price takes a swing low, it's supposed to go up. And then you plot your long position here, and then you put your stop loss in the most recent swing low. This is not a strategy. I'm just giving you an example. And so for now, price has not gotten here yet. So what you're going to be entering is a buy limit, which is a form of a pending order. So the difference is a pending order is an order that you execute at a later time at this price you specify. So unlike the other one where we just go to the market application, that is your MetaTrader, and you enter a buy or a sell, in this case, you just come here, you copy the price, this price, you go to your MetaTrader, you impute it as a buy limit order, you copy the price here, this is your stop loss. Your stop loss is usually the price below, okay? You copy it and you put it in your stop loss. This is after you're done with your risk management calculation, which we will come to later. So you copy your stop loss and you put it here. And let's say you're aiming for 1:2, which is risk to reward ratio of 1:2. That is, you're aiming to make 2 times what you're risking. And you copy this take profit order and then you put it there and you put your lot size based off of your calculation, which I will teach much later. You're going to be entering what we call a pending order. The reason is because price is not here at the moment. And so at a later time, when price moves downwards, okay, and then comes to this place, then the trade is going to officially open and it's going to be reading profits or loss based on where the candlesticks are forming. If it comes in here and ticks your trade in at this price level, okay, this level of price, if it comes in at this level of price and ticks you into the trade, then if it's going down, it's going to be counting you into a loss. Or if it's going up, if price comes in here and goes back higher this way, you're going to be in profit. Okay, so that's basically limit order. Instant execution or market order is instant execution. You buy at a specific price or you sell at that specific price immediately. Whereas pending order is buying or setting your trades at a later time your entry level. Okay, so by market orders, instant execution of trades. Pending orders, you setting your trades to be triggered at a later time when price reaches your entry level. So now, market order, you're buying at the current price. That's one thing you have to note. In market order, you're buying at the current price, buying or selling at the current price. Right? And then also, it's just basically like you going to a store to, let me explain it now in our modern shopping term. So it's basically you go into a store. Let's say you go to Amazon website and then you place an order for a shoe, for a pair of shoes, yeah? You just buy it at the price where it is, right? Let's say the shoe is $50. You place an order, you pay with your PayPal or your credit card or your debit card, whichever one you use, and then you just purchase the shoe at the price it's at. That's basically market order. It is instant. You're buying at the best available price. Okay? Whereas in the case of pending orders, you're looking at it from a point of buying your, similarly, let me use the Amazon store example for you. So you go to an Amazon website, maybe for the domain name of your country or the one that ships to your country, or you just check a random online mall in your country, and then you look at the price of a particular shoe, and it's not maybe favorable for you at that point. You feel like maybe the price is going to go lower, and you place an order in the store. That is if they allow for such orders, that, okay, let's say the price is at $50 at the moment. You place an order that you want to buy this shoe when the price gets to $45. So when the price gets to $45, they ship the shoe to you and they debit their money from your PayPal or your wallet or whatever it is that you connect to the account of the online store or the online mall, right? So that's more like a pending order. The order is pending until the market moves to that point of price that is of interest to you, that you have set to enter the trade. I hope this is as simple as it can get, right? So there are several types of or examples of pending orders, right? And then we'll give the examples and we'll explain them. So for the purpose of professionalism, right? And for the purpose of having a certain level of comfort in your trading and not just entering trades anyhow, I would personally advise that as beginners, you use pending orders. I feel like I honestly believe they are the best. That's what I use. It fills you in with much more calm than market orders. And then it helps you to regulate your trading. Market orders, you can be saying different things and then you're just executing trades at random. But pending order, you must be looking out for a particular confluence of price. Some certain conditions must be met in the real sense of setting pending orders. Some certain conditions must be met before you can set, okay, this is the limit or the level that I'm willing to enter this market or enter this trade at. I hope you understand this. So now, examples of pending orders, right? So we have buy limits. Let me use alphabets. And then I'll go to the chart and show you buy limits. And then we have sell limits, okay? This is the most ones I use, actually. And then I think that's like the most important thing for you to know. For the most important tool for you to note now, buy limits and sell limits. Now let's go to the chart. Let me show you buy limits and sell limits. So This is basically a buy limit, what I just explained. So you think price is going to come to this low and then reverse back up because you feel like there's liquidity at this low. I'll explain all of that later. So price comes here, fills you in at the price that you have chosen, and then goes in your direction or goes against you and hits your stop loss price. This is your stop loss price, this level. This is a buy limit. Now, a sell limit would be the opposite of buy limit in the sense that you're waiting for price to come to this high. Now, price is at this point. Currently, you can see where price is at. This is where price is at now. So you've set a sell limit order here. So you look at short position, right? And then you place it here. And your stop loss is at the most recent swing high. That is higher than this one, which is here. So what you would be setting if it's a sell trade, it's a sell limit. If you're looking at a sell position, okay, the market has opened. Okay, thank God. So you're looking at a sell position. So what happens here is if price comes back from here and then goes to this point, it kicks you into the trade. If the candlestick move upward and hit here, it kicks you into the trade. And then if the candlesticks move back down, you are in profit. But if it gets to this point and continues going up, you lose the trade. When it hits your stop loss here, you practically lose the trade. So you use buy limits to enter buy pending orders, and you use sell limits to enter sell pending sell orders. Okay? So I'll just give a bit of notes and then we would get to this, right? So let's look at buy limits now. So it's an order placed below the current price with the hope that price gets to it and reverses back up, right? That's for buy limit. And then for sell limit, an order placed above the current price with the hope that when I say hope or when I say feelings, I do not mean your feelings. I mean whatever strategy or system of trade that you're using. So with the hope that price gets to that level and reverses back down. Now, this is basically what you need to know as a beginner about pending orders, okay? Whether pending orders and instant execution. There are other types of pending orders, but at the moment, that would not be important for you to consider. In all honesty, I do not like making the videos so long, right? So I think this would be important for you. So another thing we are going to be considering still under the various types of order is your trailing stop. So I did not used to use this until very recently. So let me go to the chart and show you how trailing stop works. So let's say you're in a buy trade here now. Let me delete all of this, right? So let's say you're in a buy trade here and you're aiming for 1:4, right? And let's say you're in a pending, you enter a pending order, and for some reason, price moves all the way from here and hits you in here and moves in your direction favorably so. Now look at what we are trading here, this box. So let's say you're in a buy trade and your aim is to get 1:4. which if you watch where this is changing, this is where I'm looking at risk to reward ratio of 1:4. It means your stop loss, your take profit is 4 times bigger than your stop loss in terms of what you're going to lose and what you're going to gain. So let's say price comes here in the future, gets you in, and you get to 1:2. And this figure here is your stop loss, right? So what most traders do is, in order to lock in some profits or to prevent their trades from losing entirely, when the price moves in their favor, like just as it is doing here, hypothetically speaking, when price moves in their favor for a considerable amount of distance or pips, they tend to move their stop loss. They change the stop loss price on their MetaTrader. Like I said, I'll teach you trade execution on your MetaTrader and TradeLocker and all other platforms, okay? In a much more, I think in week 2 or so. So they tend to move their stop loss price, take it out and put their entry price. Now, what it does is it brings their stop loss to the entry point. Now, they can't lose anything if this trade was to, hypothetically speaking, still turn back against them in the future. It would just hit this point and close them on $0 or a little above or a little below $0, depending on the broker and the current spread of the market. I talked about spread in my previous video. So that's what trailing stop means. It just means you're moving your stop loss gradually as price keeps moving in your direction, in your favor, right? You keep moving your stop loss gradually. So let's say price gets to 1:3, and I can't see the 1:3 level now, but let's say price gets to a reasonable extent, and you want to lock in half of your profit. All you need to do is you check, okay, this is where I want to lock in some profit up to, and then you change the figure of your stop loss from this entry price to the price level of where you want to lock in your stop loss. So right now, your current stop loss is at 1.4, watch where my cursor is, 1.43372. That's where your stop loss is at. And then you want to lock in profit half of this trade. And at the moment, this looks like half of the trade. So the price is here. Hypothetically speaking now, the price is here in the future. Watch my arrows. And you want to lock in half of your profit. All you need to do is this line you've put here that indicates half of your price movement so far. You just copy this figure and put it in your MetaTrader as your stop loss. What it does is it protects all of the money that you've made from here to here. So even if the trade in the future, hypothetically speaking, turns back against you and hits here, your trade is going to close, but you still have some profits locked in. That is basically what a trailing stop means. And that is basically the effect of a trailing stop. I hope this is easy to understand. If you have any questions so far about what I have taught, you can drop it in the comment sections, okay? Now, moving on. We've talked about trailing stop. Do I need to write a note about this? I do not think I need to write a note about this, but let me just give you a bit of a write-up. Okay, this is a stop loss order. An open position, and which automatically moves once profit becomes equal or higher than a price level. Okay, so it's basically a fluctuating stop loss. to lock in profits as the trade moves in their favor. So a stop loss order attached to an open position which automatically moves once profits becomes equal to, right, or higher than a price level. It is basically a fluctuating stop loss used by traders to lock in profits as the trade moves in their favor. So that's all for week 3. We've lesson 2, part 3. We've considered the various types of Forex orders that are important for the beginner Forex trader. And we would move on to part 4, where we would wrap up the week or this part of the lesson and we proceed to other things. Thank you very much.